Hello. Let me go over some question for chapter 10. Um, Now, question number 1. A project has a sales of 72,000, cost of 53,000, depreciation of 7,200, and a tax rate of 34%. What is the operating cash flow? Now, if you read the book, there are a couple of formulas for the operating cash flow, OCF. So I am using one of the formulas over here. All these formulas should give you the same answer. Now, so OCF is equal to net income, which is 11,800. You add back depreciation, which is 7,200, minus taxes, which is 12, and the answer is 14,988. Okay. You can try other formulas, but they should give you the same answer. Number 2, Newton Industries is considering a project that is expected to produce sales of 440,500 for 3 years, profit margin of 4%, initial investment 53,000 in fixed assets, and depreciated on a straight line basis to 0. The project is expected to increase account receivable by 15,500, decrease account payables by 10,750, decrease inventory by 7,500. What is the cash flows at time 0? Alright, so the cash flow at time 0 is the initial investment $53,000, plus you have to make adjustment for working capital. Okay, so as you can see, let me use the pen. If account receivable increased by an amount of 15,500, what is account receivable? It is the amount of money that the customer owe the company. So if the amount of money customer owe the company they have not paid yet, that would reduce the amount of cash, at time 0. So that is why you have to deduct 15,500. And then, so what it means is, deduct 15,500 because account receivable increases by 15,500. Now account payable decrease by an amount 10,750. Now account payable decreases mean the company has been using money to pay off account payable, so cash has been reduced by an amount 10,750. Now if inventory decreased by 7,500, that means the company has been selling inventories for 7,500 more, so that would increase the cash of the company. So in summary, the company paid 5,300 at the beginning and make adjustment for 15,500 for account receivable, 10,750 for account payable, and 7,500 for inventory. So the ending result is negative 71,750. So that is how much cash outflow at time 0. Okay. Now question number 3. Very similar. At the beginning of the year, the current account receivable value is 225,000, and this is a projected value at the end of the year, 305,000, so increased by 80,000. Now when account receivable increased by 80,000, the cash should go down by 80,000, because this is the amount of money the customer has not paid yet, so the company has not received yet, so therefore it reduced the cash by $80,000. Account payable increases from 202,000 to 238,000. So when account payable increases by 36,000, so let's go back. This should be deducted, and when account payable increases by $36,000, the cash should increase by 36,000 because the company has not paid the suppliers yet. Okay, the account payable increases, the company has not paid yet. Inventories increased from 334 to 374, which is a decrease of $40,000. So inventory increases, meaning the company bought more inventories, so that would reduce the cash. So you have negative 80,000, you have increased 36,000, you have negative 40,000, so the net is negative 84,000. Okay. So the cash flow would go down by $84,000 at the beginning of the year. Now number 4, an asset that costs $42,000 and is classified as 3-year mark property. What is the depreciation expense in year 2? As you can see in the table, the depreciation expense in year 2 is 44.45% of the book value. Right, so if the book value is 42,000 and you multiply with 0.4445 and you get 18,669. So that is the amount of depreciation in year 2. Question number 5. Now this is a 5-year mark property. What is the book value of the equipment at the end of year 4? So at the end of year 4, the company has used 20% of the book value in the first year, 32% in the second year, 19.2% in the third year, and 11.52% in year 4. So what is left after year 4 is 1 minus 20% in the first year, 32% in the second year, 19.2% in the third year, and 11.52% in the fourth year. Alright, so that is how many percent left of the book value. Multiply with $73,000 book value originally, you get the book value at the end of year 4, which is 12,614.40. Alright, question number 6. Calculate the NPV of this project. So the initial investment is 39,900, right, for fixed assets, and 9,900 for net working capital. The project is expected to produce OCF of 11,400 a year for 4 years, and the net working capital can be recouped at the end of the project. Alright, so you can recover the net working capital. The fixed assets have a value after tax, a salvage value after tax of 16,900. Alright, so at the beginning, this company spent 39,900 on fixed assets and adjust for working capital 9,900. So the initial cash flows would be negative 49,800. Now the working capital for in year, the operating cash flow in year 1 is 11,400. Year 2 is the same, 11,400. Year 3 is the same. In year 4, on top of 11,400 OCF, the after tax salvage value is 16,900. Okay, should be added to the cash flow in year 4. And the working capital in year 0 should be recovered in year 4, so you have to add back 9,900 to the cash flow in year 4. So the cash flow in year 4 is 38,200. Okay. So you put in the formula to get NPV with the interest rate or the required return is 13.9%, or you can simply use the NPV function in the financial calculator. So I'm using the TI-83 or TI-84. You go to apps, choose option 7 for NPV, put in NPV, open parentheses, 13.9, which is the interest rate, cash flow at time 0, negative 49,800, open parentheses, cash flow 11,400 and 38,200. And because you have 11,400 for 3 years, you can use the frequency 3 for 11,400 and only one time for 38,200, and then enter. You should get the same answer, negative $591.92. So the NPV is negative. You should reject the project. So the answer is no, because NPV is negative 591. Number 7. A fixed asset has an initial cost of $31,000. What is the after-tax cash flow from the sale of assets if the pre-tax salvage value at the end of year 3 is 12,500 and the tax rate is 34%? So first you need to determine the book value at the end of year 3. Alright, so at the end of year 3 you have used 20% in the first year, 32% in the second year, 19.2% in the third year. So whatever left would be the book value in year 3. So 1 minus 0.2 minus 0.32 minus 0.192 times 31,000, you get $8,928. So the after-tax salvage value would be equal to, first of all, the selling price, as the company is able to sell the assets for 12,500 minus the amount of taxes. So what is the amount of taxes? That would be how much tax the company had to pay on the profit when selling the assets. So the original, so the pre-tax value at that time is 12,500, which is the selling price, minus 8928, which is the book value at that time. So that will give you the profit for that when selling the assets, times 34%. So that would give you how much taxes you have to pay. And so the after tax salvage value would be 12,500 minus the amount of taxes and equal to 11,285 and 52. Number 8. Now, for this question, calculate OCF. What is the depreciation tax shield? Now, for the OCF, you have another formula which is equal to EBIT plus depreciation minus taxes. So EBIT is equal to so it's not in here. I can easily show you that EBIT would be equal to sales, which is 689,900 minus cost of goods sold, which is 444,800, and minus depreciation, which is 117,400. And that would give you the EBIT, which is the answer is right here, 127,700. Okay, so it is 127,000. Oh, sorry, 700. Oh man, sorry, 127,700. This is EBIT, earning before interest and tax. So you have EBIT plus depreciation, add back depreciation, which is 117,400, and minus taxes. How much is taxes? Taxes, which is equal to 35% of EBIT. So the amount of taxes would be equal to this one, EBIT times 45%, and you get that equal to taxes equal 44,695. Okay, 44,695. That is how much taxes. So 127,700 EBIT plus depreciation minus taxes, and OCF is 200,405. Okay, the amount of tax shield is basically the tax rate times depreciation. So 0.35 times depreciation, 117,400 equal to $41,090. Alright, number 9. Number 9. I'm gonna skip number 9. You can look at the formula. Everything is similar to before. Alright, and number 10. Calculate operating cash flows using 4 different approaches. So if you read the book, you can see that there are 4 different formulas to calculate OCF, but in the end they should give you the same answer. So OCF equal to EBIT plus depreciation minus taxes. OCF, another formula is OCF equal to sales minus cost minus taxes. Okay. Another approach is OCF equal to sale minus cost times 1 minus tax rate plus depreciation shield, which is tax rate times the amount of depreciation. And another one is OCF equal to net income plus depreciation. So all of this should give you the same answer. Okay. Number 11 is similar. Alright, so you can I'm gonna skip number 11, go to number 12, which is a little bit more difficult. For number 12, we are required to calculate NPV again. So you can use whatever formula for OCF, but at the end of the day, they should give you the same answer. So for example, in here I'm using the OCF, this formula. So OCF is equal to sale minus cost times 1 minus tax plus depreciation tax show. The sales is equal to $2,100,000 minus cost, which is $795,000 times 1 minus the tax rate, which is 1 minus 0.34 times 0.34 times $2,760,000 over 3. That is the amount of depreciation, because this is a straight line. Okay, this is a straight line depreciation to 0 over 3 years. So each year depreciation is equal to $2,760,000 over 3. Then after we have OCF, we can find NPV. First, the initial cash flows would be equal to the initial cost is $2,760,000. Alright, so negative $2,760,000. The cash flow from term 1 to term 3 is equal to the operating cash flow, $1,174,100. So you put in the calculator, you calculate NPV, and you get NPV equal to 59,990.09. Alright. Number 13 is very similar, except that it is you need to consider the net working capital. For example, this company is considering a new 3-year expansion project that requires an initial fixed investment of $2.46 million. The assets will be depreciated straight line to 0 over 3 years. At that time, its value will be 0. $2 million in annual sales with cost of $695,000. Initial investment in net working capital is $220,000, and fixed assets will have a market value of $300,000 at the end of the project. Alright, so at year 0, the cash flow would be the initial assets investment, which is $2,460,000, minus the initial investment in working capital, which is $220,000. Okay, and so the initial cash flows would be negative $2,680,000. Then you calculate OCF using the same formula we have before. Sales $2 million minus cost $695,000 minus times 1 minus tax, which is 35%, times 0.35 times depreciation, which is $2,460,000 over 3. Okay. In year 3, on top of the OCF $1,135,250, you have to recover $220,000 net working capital in year 0. Alright, in year 0 you deduct $220,000 for investment in working capital, but in year 3 you have to recover that. And also you have to consider the after-tax salvage value. The assets was selling at the end of year 3 for is selling at the end of year 3 for in year 3 for $300,000. Okay, and the book value at that time is 0. So you have to pay a profit, you have to pay taxes on the profit. So the taxes will be equal to 0 book value minus market value $300,000 times 0.35. So this is the market value $300,000 of the fixed assets minus the amount of taxes that the company has to pay when selling the fixed assets. So you add all of them together. The cash flow in year 3 is $1,550,000 to 50. Alright, so you have all you need to calculate NPV. Cash flow times 0, negative 2,680,000. Cash flow in year 1, 1,135,000 to 50. Cash flow in year 2 is the same as cash flow in year 1. Cash flow in year 3 is 1,550,000 to 50. So using a financial calculator, you should be able to get NPV equal to 135,519.04. Alright, so pretty much we are all set with the correction for chapter 10. So after after you do sample correction for chapter 10, review the slides, read the book, you should be able to work on the homework for chapter 10. Okay, so any question, please let me know. Thank you. Bye bye.